Trading is an ever-changing landscape. Strategies that work today might falter tomorrow. Traders must master the art of adaptation, customize strategies to fit real-world conditions. Like a toolbox, strategies need adjustments. Adapting is an ongoing process. Markets evolve with economic data and events. Successful traders refine their approach. This journey demands patience and discipline. The rewards are substantial. Many trading strategies originate in theoretical realms, often backtested on historical data. While this provides a foundation, it's crucial to recognize that real-world trading presents a different beast altogether. Consider a trading strategy designed for a ranging market. In theory, it excels within a defined price channel. However, markets rarely adhere strictly to such patterns. Volatility may surge, trends may emerge, and the strategy's effectiveness might diminish. This is where adaptation comes into play. Traders must bridge the gap between theory and practice. This involves understanding the underlying principles of a strategy and identifying its strengths and weaknesses. For instance, a strategy designed for ranging markets might incorporate indicators like Bollinger Bands or average true range. To adapt it for trending markets, a trader might add trend-following indicators such as moving averages or the average directional index. By combining theoretical knowledge with practical adjustments, traders can transform a basic trading strategy into a powerful tool for navigating the complexities of the markets. Imagine a skilled craftsman adjusting a precision instrument. Traders optimize parameters for optimal performance. Parameters dictate a strategy's actions. For example, moving averages with specific lengths. These lengths influence signals. Optimizing parameters is crucial. Shorter averages generate more signals but more false alarms. Longer averages reduce false signals but lag. The goal is to balance sensitivity and reliability. This involves trial and error guided by backtesting. Parameter optimization is ongoing. As market dynamics shift, so should parameters. Continuous fine-tuning ensures strategies remain effective. Moving averages are like a trader's compass, smoothing out price fluctuations and revealing the underlying trend. But choosing the right moving average length is crucial for success. A shorter moving average, such as a 10-period MA, reacts quickly to price changes, making it suitable for short-term trading or volatile markets. However, it's more susceptible to whipsaws, generating false signals in choppy conditions. Conversely, a longer moving average, like a 50-period MA, filters out more noise, providing a clearer picture of the long-term trend. It's less prone to whipsaws, but might lag behind significant price movements. The optimal moving average length depends on the trader's time horizon and the instrument's volatility. A day trader might favor shorter MAs, while a swing trader might opt for longer ones. Experimentation is key. Backtest different moving average lengths on historical data to determine which settings yield the most favorable results for your chosen trading style and market. Section 5, MACD, unveiling momentum shifts for profitable trades. The MACD, or Moving Average Convergence Divergence, is a versatile momentum indicator. It comprises two moving averages, the MACD line and the signal line. Standard settings are 12, 26, and 9. Traders can experiment with different periods to adjust sensitivity. Shorter periods are more responsive, while longer periods emphasize the trend. Section 6, backtesting your strategy's proving ground. Before deploying a trading strategy in the live market, it's crucial to subject it to rigorous testing. Backtesting involves simulating trades on historical data to evaluate its potential effectiveness. Think of backtesting as a flight simulator for traders. It allows you to test your strategy in a controlled environment without risking real capital. By analyzing its performance over different market conditions, you can gain valuable insights into its strengths and weaknesses. Several backtesting methods are available, ranging from simple spreadsheet calculations to sophisticated software programs. The chosen method depends on the complexity of the strategy and the trader's technical expertise. Regardless of the method, backtesting should encompass a sufficiently long historical period, ideally covering various market cycles. This provides a more comprehensive assessment of the strategy's robustness and helps identify potential pitfalls. Section 7. Analyzing backtest results, unveiling hidden insights. Backtesting is about extracting meaningful insights from numbers. Scrutinize performance metrics to understand past strategy performance. Key metrics include win rate, average win-loss ratio, maximum drawdown, and profit factor. Win rate shows the percentage of winning trades. Maximum drawdown indicates the largest decline in the trading account. Profit factor measures overall profitability. Analyzing these metrics helps traders improve their strategies. Section 8. Fine-tuning based on backtesting, a data-driven approach. Backtesting provides a data-driven foundation for fine-tuning trading strategies. By analyzing historical performance, traders can identify areas for improvement and make adjustments accordingly. For example, if backtesting reveals that a strategy generates excessive losses during periods of high volatility, a trader might consider incorporating volatility filters. This could involve using indicators like average true range or ATR to avoid trades when market fluctuations exceed a certain threshold. Similarly, if backtesting shows that a strategy tends to underperform during specific market conditions, such as ranging markets or trending markets, a trader might adjust the parameters of their indicators or incorporate additional indicators that are better suited for those conditions. The key is to approach fine-tuning systematically, making incremental changes based on backtest results. This iterative process helps traders refine their strategies, optimizing them for their chosen markets and trading styles. Section 9. Risk management, safeguarding your trading endeavors. Even the most meticulously fine-tuned trading strategy can falter without proper risk management. Protecting your capital is paramount in the unpredictable world of trading. One fundamental risk management principle is position sizing. Determine the appropriate amount of capital to risk on each trade based on your account size and risk tolerance. A common rule of thumb is to risk no more than 1 to 2% of your account on a single trade. Another crucial aspect is setting stop-loss orders. These predefined exit points limit potential losses by automatically closing a trade when the price moves against you beyond a certain level. Stop-loss orders act as your safety net, preventing small losses from snowballing into significant setbacks. Furthermore, consider implementing a trailing stop-loss strategy. This involves adjusting your stop-loss order upward as the price moves in your favor, locking in profits while allowing for potential further gains. Section 10. The ongoing journey of adaptation and fine-tuning. Adapting and fine-tuning trading strategies is not a one-time task, but an ongoing journey. Markets are constantly evolving, influenced by economic data, geopolitical events, and even social sentiment. A successful trader embraces this dynamic nature, continuously refining their approach to stay ahead of the curve. This ongoing process involves staying informed about market trends, monitoring economic indicators, and adapting to changes in market volatility. It also requires a willingness to challenge your assumptions, experiment with new indicators or strategies, and learn from both successes and failures. The key is to remain adaptable, flexible, and open to new information. By embracing the dynamic nature of the markets and continuously seeking to improve your trading strategies, you can navigate the complexities of trading with greater confidence and success. Section 11. Conclusion. Mastering the art of adaptation for trading success. In the ever-changing world of trading, adaptation and fine-tuning are not merely options, but necessities for success. By embracing these principles, traders can transform theoretical strategies into practical tools for navigating the complexities of the markets. Mastering the art of adaptation involves understanding the underlying principles of trading strategies, optimizing parameters, and rigorously backtesting to ensure robustness. It also requires a commitment to ongoing learning, adapting to changing market conditions, and continuously refining one's approach. While the journey of adaptation and fine-tuning demands patience, discipline, and a willingness to learn from both successes and failures, the rewards are substantial. By embracing these principles, traders can increase their profitability, manage risks effectively, and ultimately achieve their financial goals in the exciting and challenging world of trading.